Hey everyone, welcome back to the channel. Today, we're diving into the perfect storm that rocked the markets earlier this month. Five key catalysts converged, causing a surge in volatility. We'll break down what happened and how you can navigate these choppy waters like a pro. First up, the dreaded, our word, recession. The US yield curve inverted back in 2022, signaling a potential recession. While it didn't happen then, last week's economic data hinted that it might be knocking on the door now. We saw unemployment tick up and key indicators like the ISM manufacturing production and Chicago PMI fall more than expected. The SOM rule, a reliable recession indicator, also triggered, adding to the uncertainty. But here's the twist. Recessions don't typically start with unemployment this low. Could this be a false alarm, or are we in for a bumpy ride? Let's keep an eye on those consumer-facing sectors. They're already showing signs of strain. Next, let's talk about the Bank of Japan and the infamous yen carry trade. Japan's ultra-low interest rates have made the yen a popular currency for borrowing to invest in higher-yielding assets. But with Japan raising rates and the yen strengthening, investors are scrambling to unwind these trades. The result? A sell-off in Japanese equities that sent shockwaves across global markets. But here's something to ponder. The unwinding of these trades also triggered a flight to safety in US bonds. Is this the calm before the storm, or just another bump in the road? Now, on to earnings season. While more companies than usual beat their earnings estimates, the surprises were smaller than average. Revenue growth was underwhelming, and EPS estimates for Q3 are already being revised down. The silver lining? Earnings growth continues. But will it be enough to keep the market afloat? When Warren Buffett makes a move, the market listens. Berkshire Hathaway's decision to have its Apple stake and hoard cash raised eyebrows. Is this a sign that even the Oracle of Omaha thinks the market is overvalued? And with Berkshire holding more short-term US Treasuries than the Federal Reserve, what does this mean for the future? Finally, let's touch on the upcoming US election. With national polls showing a close race between Trump and Harris, political uncertainty is adding to the market's jitters. While this may not be the primary driver of volatility right now, it's definitely something to watch as we move closer to election day. So, what does all this mean for you? Is this market dip an overreaction, or the start of a larger decline? Some analysts, like those at BlackRock, think the recession fears are overblown. The Bank of Japan might slow down its rate hikes, and central banks are always ready to step in if things get worse. The VIX, or Fear Index, is up, but history shows that these spikes often present buying opportunities. If the market's recent moves have you losing sleep, it might be time to reassess your risk tolerance. Here's the key takeaway. Volatility isn't something to fear, it's something to prepare for. Estimate your fair values, keep some cash ready, and always think long-term. When the market gets choppy, that's when the best opportunities arise. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you never miss an update. Until next time, stay calm, stay informed, and stay invested.